Hello, and a very good morning for those of you in the United Kingdom, and afternoon for you, for most of you elsewhere. My name is Richard Banks, and I am the host of Euromoney live streams, and it's great to be back with you today. Just as always, a quick disclaimer. This live stream is for information purposes only. We are not providing investment or transaction advice. All opinions are those of the presenter, the guests, and the audience, not of Euromoney Institutional Investor PLC or any other agencies, and all content is copyright Euromoney 2020. It's great to be back after a 2-week break where I had the good fortune of going to Dubai, my first business trip in 8 months, to visit some clients and friends. It was great to get out. Something I think everyone should try and emulate, safely of course. Business is happening, the city is open, and I'm very much looking forward to going back, and I hope also to going to Saudi Arabia in the early part of the new year, where I hope to meet in person our guest today. It's a great pleasure to welcome to the live stream His Excellency Mr. Mohammed El-Kuwaiz, Chairman of the Capital Markets Authority of the Kingdom of Saudi Arabia. Your Excellency, good afternoon and welcome.
Good morning to you, Richard, and good afternoon to everyone who's joining us.
So, Your Excellency, before we start the proper interview, I'm going to have you been up since 4 a.m. this morning, like me, watching the election?
Not quite.
Well, a bit of time difference. It's nail-biting stuff. Very exciting, very interesting to watch. I had to tear myself away for this interview, but I know it's going to be just as interesting and as exciting talking to you for the next 45 minutes. In this Saudi series, we've talked to a number of your colleagues, the Minister of Finance, of course, the Governor of SAMA, as well as private sector and international representatives. But I'd like to start with the actions that the CMA has taken to ensure capital markets systemic stability in the kingdom during the unprecedented events of the last 8 months. So talk us through, what you did and what effect it had.
Thank you very much, Richard. Well, the soundness and the stability of the financial market is a key component to support the country, both before the pandemic and during the COVID pandemic. In this regard, we can talk about the actions we've taken both before the pandemic to make sure that the market is more robust and prepared for potential shocks, as well as what we've been doing during the pandemic thus far. So if we start before the pandemic, one of the most important factors that we had been focusing on was to diversify the investor base in the Saudi capital market to include both more institutional investors as well as more international investors. Because we believe the diversification of investors allows for more diverse trading patterns and more diverse fund flows. And this offers a stability to the market rather than having all investors coming in at once or leave at once and then have an adverse shock on the market. We also, before the pandemic, approved the establishment of a central counterparty, or a CCP, and along with our colleagues in SAMA, now oversee its activities. And this would help us better control settlement risk, both because we've moved recently from T+0 to T+2, but also because we recently launched a derivatives market, and settlement is critical there. We also continue to focus on the quality of our governance and our disclosures to give both local and international investors more confidence in investing via the capital market. This resulted in a market increase in Saudi Arabia's global ranking in terms of governance, where we are now in the top 5 globally on most rankings.
Congratulations, well done, that's amazing. Sorry, I didn't know that. It's a fact I should have known, Your Excellency, and I apologize, but it's very impressive.
So that, Richard, is what we've done before the pandemic to prepare for any potential shocks, and I think this has served us well. Now, if we shift to what we've been doing since the start of the pandemic and the time thereafter, the most important factor has been to keep the markets open, because we believe the market serves as a valuable source of liquidity for investors and of financing for issuers. And during the pandemic, the need for both liquidity and financing may be higher than at any other time. And while this certainly resulted in more volatility earlier in the pandemic, and we can acknowledge that excessive volatility in general is not a desirable thing. However, the markets have remained orderly throughout the pandemic. And as a matter of fact, the main volatility control mechanisms we have in place in Saudi Arabia, which are our daily trading limits, has only been reached once this year for the overall market, and only during intraday trading, and not for any particular market close. This has actually given us further confidence in the robustness of our volatility control mechanisms. We did, however, shorten our trading hours during the lockdown phase of the pandemic, simply to allow market participants to access and operate the market more effectively. And when the lockdown phase, we emerged from the lockdown phase, I think we resumed normal trading hours. We also suspended in-person shareholder assemblies to comply with national safety precautions. The transition, however, didn't seem very abrupt, given that Saudi Arabia was the first market in the world to mandate e-voting and e-proxies for listed firms. So in some respects, firms and the market overall already had the infrastructure in place for this. We recently also lifted this suspension to allow for more shareholder engagement. And we are continuing to monitor the health situation in order to make further decisions as needed. Finally, we provided additional reporting grace periods for market participants with respect to certain disclosures. This was needed, we believe, to give market participants more room to comply in light of the circumstances. But possibly more importantly, we didn't waive any of our reporting or disclosure requirements, because we believe that the proper disclosure and governance are more important now, anytime, in light of these volatile times. So more broadly, Richard, the pandemic has given us the opportunity to assess the changes that we've made over the last few years to ensure that they strike the right balance between providing flexibility in terms of reporting deadlines while ensuring the protection of investors. And while we're certainly not out of the woods yet, the evidence thus far has been encouraging.
It's an impressive list, Your Excellency. There's just a couple of things I'd sort of like to unpack a little bit on that, if I may. As regards the reaction of the investor base, so I'm talking both domestic and international, because the market has become more institutional over recent years, again, both domestic and internationally, do you feel that that provided a sort of a floor to the market, or an element of stability there, because this was not speculative money, this was, you know, proper investment money? It wasn't retail. I mean, one of the characteristics of the Saudi market for many years was that it was a highly retail market. So do you feel that the introduction and encouragement of institutional investment, both domestically and internationally, worked in the way that you wanted it to?
I would say it had a big component to adding to the market stability. And if I may, I'll just place 2 data points on this.
Please.
One is, since Saudi Arabia opened its market to international investors in 2015, and then we followed up with a series of changes to the regulatory infrastructure, we have seen fund flows in almost to the tune of 100 billion riyals from international investors in 2019. And more importantly, the period to date in 2020 was an important experience to see how these international investors would behave in light of a global pandemic shock. What we experienced was, not only did the funds not withdraw, actually the inflows continued. So if we look at the year to date, we've seen additional fund inflows to the tune of around 20 billion riyals from international investors. And there was only 1 month in the year to date where we saw net fund outflow, and that's marginal in compared with the inflows over the past 2 years. So it has been, at least thus far, an element of stability.
Thank you. To what extent? I mean, one of the great challenges in March that we all faced, and I'm sure it's the same with you, and I'd like you to sort of expand on a little bit, was, suddenly you had markets that were used to operating from offices, with high-speed connections, with all the security, with all of that, trading markets, suddenly had to migrate to people's kitchens. And, there were, I know from some firms I work with, there were disaster recovery plans in place, but that was if you lost your office, you had another office. It wasn't a question of suddenly having to operate remotely. That was a huge challenge. How is the CMA involved in making sure that that process was secure, orderly, and effective?
So I would say a couple of things to that, Richard. Number one is the transition has been somewhat seamless because of the fact that so much trading was already automated in the Saudi markets prior to the pandemic. So even prior to the pandemic, over 90% of trading values are both originate and are transacted online. Mm-hmm. So it hasn't really changed significantly the structure of the market, maybe just on the marginal level. There has been, of course, like any other industries, security and safety precautions, particularly as we started to see curtailment of movement and eventually moving into lockdowns. And I think it was important for us to, on the one hand, make sure that the markets remained open, but at the same time, make sure that market participants, both intermediaries, people who work in tadawul, and investors themselves remain safe and don't need to try and come in or out on close margins of the lockdown. So that is one of the reasons why we restricted the trading hours. I think as we started to restrict the trading hours, and as especially more of market participants moved to transact business out of their homes, I think it became critical for us to do two things. One is to be very close to the industry, whether it's the market or market participants, to make sure that they have disaster recovery plans in place, and all firms have disaster recovery plans in place, but that they are appropriately tested. And I think doing a lot of simulation around that testing was very valuable for market participants. And second was that market participants maintain the highest degree of confidentiality, and that they have precautions in place to ensure client confidentiality as the traditional venue of business moves from the office to elsewhere, either in their homes or anywhere else in the world.
Yeah, I hadn't thought of it like that, but yes, I mean, I suppose that's right. You don't want your 7-year-old daughter seeing all the trades you're doing. One of the the main, or another main role of the CMA is in, investor protection, particularly retail protection, and that type of thing. So, whilst of course we are primarily looking at the institutional market, you do have a wider role. So, what did you do specifically to support, the people in the market, the Saudis in the market, and the private sector?
Well, Richard, if we think of an efficient capital market, we need to try and strike the right balance between helping issuers, which are companies, and between helping investors, who are both individuals and companies, which is really the intersection that the capital market serves. So if we start with the issuers, which is one side of the equation, the CMA's main contribution was to help issuers gain financing, either through equities or debt issuance. So even before the pandemic, this started with streamlining the IPO process, streamlining the regulations that are involved in the IPO process, as well as creating new avenues for listing, such as the Numu market. And the routes for listing, like the newly launched direct listing route. This, we believe, resulted in more companies wanting to list. And our belief is that this not only provides equity funding for businesses who may be in need for it, either for expansion or to confront these challenges, but it also helps companies reduce their overall cost of funding due to increased levels of disclosure and governance. Um, in addition to the IPO process, the regulatory improvements also started to see more activity in the debt capital market, which is rapidly emerging as a financing tool for viable businesses. This, of course, started with government issuances earlier on, and now we're seeing this expand to more and more private issuers, especially for larger financings with longer maturities. As a result of this, we wanted to create additional routes in addition to equity and debt for companies to get financed. So as a result of our regulatory changes that we've done in the past couple of years, and also some of the work that we've been doing with our colleagues in Munshaat and Saudi VC company, we've also started to see a rapidly growing venture capital or VC funding landscape. And to put this into perspective, as of the first half of 2020, and in spite of the COVID pandemic, we saw more VC funding than we did in 2019 in its entirety. Finally, we started to see some early fruits from the innovative fintech funding platforms that we started to license, like equity crowdfunding, where we see more businesses being financed than would have otherwise been able to secure funding through other channels. I think the current record for funding on one of these platforms is currently 2 hours to close financing.
Remarkable. So one of the narratives that came out, let's say early April, so just after the sort of whole pandemic thing became real, regarding Saudi Arabia particularly, was this idea, well, you know, that's going to put a stop or delay the reform program. It's going to change the emphasis of policymakers and executives such as yourselves on the implementation of Vision 2030 and the various realization programs, of which the Financial Sector Development Program is a very important one. You know, that was, people were saying that. I never thought it was going to be true, but I'm going to ask you that question. Has it, you know, will this pandemic, will the events of this year delay or disrupt the FSDP and CMA's role within it?
So if we take a step back, Richard, I'd say the vision for the Saudi capital market was to become the region's main and preeminent capital market, and hopefully one of the most important markets in the world, particularly with the listing of companies like Saudi Aramco and other large corporates. Mm-hmm. Both, and in that regard, I would say both Vision 2030 and the global COVID pandemic have made this vision more pressing, not just for the benefits of Saudi and its economy, but for the benefit of economies across the region, who all require an avenue for financing and an avenue for investment. Now, naturally, there may be some changes in terms of prioritization or in terms of ranking of initiatives given the current circumstances, but both the direction and the pace remain very much intact. We're actually, as we speak right now, going through our annual strategic review exercise to assess these priorities and initiatives and to make whatever changes may be needed. And as we've done in previous cases with all of our strategic planning exercise, and in keeping with our commitment to disclosure, we will actually upload the results on our website as soon as we conclude.
I mean, this slightly sort of left field question, but it's interesting. Do you feel that, so, you know, when Vision 2030, FSDP, when all of these things were announced in 2016, 2017, when the big sort of change in energy happened in Saudi Arabia, there was a degree of skepticism from the international community that these things would happen because the targets were, you know, they were stretched. And, you know, I think it's fair to say that Saudi had a, you know, mixed record of achieving these big targets. Do you feel that people globally now that you talk to are beginning to sort of wake up to the fact that this is actually happening? That, you know, not everything, but the vast majority of those stretch targets that were stipulated under the initial Vision 2030 document are becoming reality, and that the narrative has changed. Do people sort of relate to it differently when you speak to them?
So I would say if we start from the standpoint of the area we operate in, which is the capital market, the vision I described for the country's capital market was defined very close to the time when Vision 2030 was released. Yes. And I think to say the least, the vision for the country's capital market was held as being equally aspirational and difficult to achieve. And yet here we are, 4 years later. If you look at a global ranking, the Saudi capital market today ranks either number 7 or number 9 in the world globally by market cap. Now, naturally, this is heavily influenced by a single big issue in the country. And naturally, we have a lot more to go in terms of other asset classes, whether it's debt capital market, derivatives, et cetera. But that being able to achieve objectives or set objectives and at least get some indication that you're moving in the right direction gives you a degree of confidence. Now, naturally, in general, and particularly in light of the current pandemic, there will always be challenges, but at least getting a sense of the pace of change is quite encouraging.
Yeah. I mean, you know, I'm not saying that there aren't still challenges. There are probably more challenges as there were, but, you know, looking back on this first 4 or 5 years of this initiative, I think personally it's achieved an awful lot more than what some of the cynics said it was capable of doing. And that's not just in the capital markets, although that's very important. That's in other sectors as well. And that's something that I think people really need to be paying attention to. That is my personal opinion. You touched on this a little bit, but, you know, these crises that we go through in finance with reasonable regularity, they're always different, but they always seem to happen. The most important thing, I mean, other than surviving and systemic stability, is the learnings that come from them. What do you think the CMA has learned from this particular crisis, and how is it similar to, say, the last one? I know that you weren't at the CMA then, but you were in the financial markets. You know, what are the similarities and differences for you between today and 2008?
So I would say, like people, no two crises are the same, which makes them difficult to absorb and deal with for everyone who's involved. But if we zoom into the current pandemic that I think everyone is touched by in some way, shape, or form, we find that it's possibly different in 2 ways from previous difficult times that at least financial markets have faced. The first difference is that previous crises, as you described, were often initially starting in the financial markets, and then they transmit onwards into the real economy. This time around, it's transpiring in the opposite direction. Yeah. This is primarily a health challenge and correspondingly an economic challenge. and the global financial system has actually absorbed the economic impact this time around rather than being a transmission mechanism for it. This doesn't mean we're out of the woods yet, of course. We're still fighting this disease, both as a country and as the rest of the world. But it forces us this time around to think not only of how to manage the risk from the crisis, but how can the financial market help this time around withstanding the current challenge and actually emerging faster and stronger thereafter. So that's the first difference. The second difference is how the financial market in Saudi specifically reacted to this challenge or this crisis if we compare it with previous episodes. And if I can use as an analogy what happened in the global financial crisis in 2008. So if we look at the global financial crisis in 2008, it originated in the US, transmitted to the rest of the world. The direct economic impact on Saudi Arabia is actually quite limited other than through oil prices. And yet in 2008, we saw the volatility of the Saudi market and the decline in the Saudi market actually register numbers that were higher than the US markets, for example, and most other markets. If we then fast forward 12 years to today in 2020, we are now witnessing a global pandemic that every country in the world is facing, Saudi and other countries. And yet we have found, at least thus far, the capital markets have absorbed it more robustly, particularly if you compare it with other capital markets, whether emerging or developed. And our sense is this is possibly a good luck, but I think it's also possibly a reflection of some of the infrastructure changes and the evolution that the market has seen thus far. So that's on differences and similarities. The second part of your question was with respect to the key learnings. I would say that, again, we're still in the midst of this, so the learning is ongoing. But I would say...
It always is. I mean, we never stop. But anyway, sorry, I interrupted. Please carry on.
I would say the learning is higher in difficult situations than it is otherwise. But I would say that particularly in this time around, the two key takeaways are, number one is that no individual and no institution can see the entire picture of a pandemic of this magnitude by themselves. At least for us, this brought into focus whatever mechanisms we had in place for cross-organizational collaboration. This included primarily the country's Financial Stability Committee, which increased its level of cooperation and meetings to help us see the linkages between our respective areas of responsibilities and our dependencies more clearly, and to identify any potential sources of risk. And I would say this leads me to the second point, which is that any crisis undoubtedly involves pain, but the pain often can be better borne if it's more broadly shared rather than concentrated in a particular group or in a particular sector. And more broadly, I would say this affirms that the best way to get out of difficult times is through cooperation rather than every man or woman for their own, or country for their own.
Yeah, and that cooperation has been especially difficult this year because it's not, people haven't been able to come together in the same room, literally. It's and of course we're, very conscious that Saudi is the G20 president this year, and, unfortunately many of the great events that were planned didn't manage to happen. It's a, bit of a disappointment, but it's good to have Saudi there doing it and leading it. I'm conscious of the time. I mean, we're 30 minutes here. We have some really good questions. So to our audience, we are, this is a live interview. We will be putting your questions maybe not all of them, but some of the good ones we'll put to His Excellency in a couple of moments. So if you want to write in the questions feed, please do that. I've got it up. That's why I'm looking off to the left. It's on a screen here to me, to the left. But Your Excellency, just a couple more questions from me before we open it up to our audience. There have been some recent measures to encourage more foreign investment into the market. Obviously the QFI and other programs like that have been, very successful. Could you just tell us a little bit about what those are, and perhaps about what we can expect in terms of two things? First of all, inflows as a result of these measures, and whether you have any more in the pipeline for next year.
So, Richard, we talked a little bit in the beginning about some of the inflows that we've seen since we've started to open up the market. The interesting point, I think, on not just the quantum of these inflows, but on the composition of these inflows, is what we have found is that a disproportionate composition of these are essentially more passive strategies rather than more active strategies, which has given us a little bit more confidence as to the permanence of this inflows. Obviously, fund flows change from day to day, but this has reaffirmed our sense of the more diverse your investor base, the more varied the lenses by which they look at the market, the more robust your market becomes. I think what we've been trying to do to augment this is to increase the level of foreign participation in the debt capital market. And I think in parallel with the QFI regime for the equity capital market, we've essentially lifted all investment restrictions on foreign investors in the country's debt capital market, because it is currently smaller and growing more rapidly. We also had a third pillar of foreign investment, which is the strategic investor program, which allows strategic investors who have a longer time horizon and therefore are amenable to lockups to actually invest even larger stakes in the financial market without having to be limited to the investment restrictions under the QFI regime. So across these three channels, and the fact that the Numu market, which is our smaller equity market, is also completely open to international investors, I think we would like to keep all channels open, not just for international investors, but for all investors from anywhere in the world.
Yeah, I mean, in many of the conversations we've had in the past, we talk about, well, you think of investors. Investors are investors, whether they're international or local, or they are investors, and you want a broad, a series of different types of them. Obviously, as Euromoney, we tend to think of it as international, but I take your point that investors are investors. And I mean, again, I think the debt market growth is very impressive, and there's still quite a lot that could be done, particularly in corporate, and also one would hope in mortgage backed, because we spoke to Fabrice and also Fabrice Tussini from SRC earlier on this year, and also the Minister of Housing about the development of that market. What's the CMA's involvement in the development of the mortgage-backed securities market?
So the one of the recognitions, and I would say one of the benefits of these cross-collaboration platforms like the Financial Sector Development Platform, is the recognition on several of these problems. No one institution can solve it by themselves. And I think the story is very similar with respect to the debt capital market. I think we can influence something, our colleagues in CMA can influence something, our colleagues in the exchange and Tadawul can influence something, but I think it needs all of us working in tandem to be able to move the needle in terms of growing the debt capital market. And so I would say one of the benefits of the Financial Sector Development Program is the creation of a separate debt market development team or a debt market development committee, which I, as the chair of the CMA, lead, which involves our colleagues from CMA, our colleagues from the debt management office. It involves our colleagues from Tadawul, where we sit on one table and we try to connect the dots on what needs to be done at which sequence in order to develop the debt market. And I think the biggest move that we have seen in the last year, which was a limitation to the growth of the debt capital market, is a market increase in the liquidity of the debt capital market. And that increase in liquidity, which was driven by the creation of more investors coming into the market. So we have started to see ETFs that invest solely in the debt capital market. So the increase in the rate of investors and the increase of liquidity has created more and more confidence for private sector issuers, in addition to the government, to start to look at tapping the debt capital market as a more viable source of funding.
Yeah, it's certainly, you know, from our perspective anyway, it's an extremely exciting development, and we're following it closely. You know, Euromoney being at its very heart the DCM focused organization, although we're much more than that now. But you know, we always, the older ones of us, always sort of think of debt markets first. My final question, which is, you know, it's a sort of a question that a number of our questioners have asked. So I will ask it, and maybe we'll have a supplemental. IPOs. You've had a number of successful IPOs, you know, since the pandemic, since the beginning of this year. Bin Dawood, the supermarket chain, and a number of others. What is the outlook in your mind for more IPOs, both from the privatization side and from the you know, pure, what I would call pure play private sector side?
I would say the short answer is it looks quite busy over the upcoming period. And the slightly longer answer is that we've seen about 8 new listings since the beginning of the year, and in spite of the pandemic, and maybe influenced by the pandemic in terms of the composition of the businesses who would like to list. Mm-hmm. We also have currently over 15 applications that we're currently reviewing for listing, whether in the main market or in the Nemo market. And obviously, while the pace of companies filing in and pulling out changes quite frequently depending on market circumstances and their own circumstances, it does.
IPOs are never simple.
If it were, we shouldn't be here, I guess.
We wouldn't have a job. That's right. So there's a question here which is related to this topic from Hadil Al-Sayed, who says, what is the latest on the Tadawul IPO? Is there any update on that? Is that something that's still under consideration?
So I think very much so. We like to, as the regulator, be a little bit distant from decisions that relate to timing and pipeline of IPOs, because we believe this helps us in our main role, which is to ensure that whatever IPO comes to the market follows the same disclosure, the same process, and the same investor protection. But we are aware that our colleagues in Tadawul and their shareholder are actually creating a pipeline in place in terms of the IPO project plan. And I think my colleague Khalid Al-Hassan from Tadawul announced the expected date that they would like to go public, which I believe is in, which I can't recall. Yeah. This is one pillar of a broader set of IPOs that are likely to come from privatizations, particularly more commercialized assets, which one would believe are closer to being ready to IPO?
So there's three questions here. I'm going to combine them into one. So Ali Al-Tarif, Muhammad Ali, and I can't see the other one, but anyway, and ESG. So, I had a conversation a year ago with a very good friend of mine who used to work at the CMA, who talked about sustainability. And what he meant was financial sustainability, i.e. the ability to continue to finance, self-financing of an organization. He wasn't particularly talking about the CMA, but it was more, that was it. And I said, no, I mean, ESG sustainability. So where are you on that in terms of, environment, social and governance? What is the CMA's role? What's coming up in that space, and how will it impact the companies, the issuers, and the investors that work with you?
So Richard, I would say a few things to that. Number one is, I think there's a growing recognition that exclusive focus of whether it's a private company or a listed firm on shareholder optimization without regard for the other stakeholders is has the potential to create imbalances. And I think the recognition of this is part of what we are seeing in terms of the emergence of ESG or any other standards, which bode for a more balanced view of corporate performance and indeed the role of corporations in a society and in an economy. So in that regard, we are actually quite supportive. I think the challenge with ESG is to agree on a particular measure. The reason being that because the industry is still nascent, we're still seeing several competing standards, whether it's ESG by index providers, whether it's integrated reporting, whether it's financial sustainability reporting or the UN Sustainable Development Goals, et cetera. And I think both the CMA and regulators around the world are generally quite conservative in terms of picking a winner this early in the process. So while directionally we are very supportive, we are closely monitoring the situation to see what standard emerges and therefore where the gaps could be and whether or not we should fill those gaps from a regulatory standpoint or whether it is better served to become a market decision standpoint in terms of investors' decision and not start as with regulations as the first step.
But it is something that you're, how shall I say, actively involved in considering how it should apply within the market, not from a regulatory point of view, but it's on your radar is the question that I was trying to really get to.
So I would say, Richard, not only is it in our radar, I would say, depending on how you select the sustainability standards, sure, several of those sustainability standards are already embedded in the required disclosures that we require of company, particularly pursuant to the Corporate Governance Code, because it doesn't exclusively focus on financial disclosures, but broadens it to look at other qualitative factors, particularly the G component of governance. So it is simply the E and the S that are more emerging and less standardized, which we're just trying to see what the emerging standard is and whether or not we as a regulator and indeed other regulators around the world should enforce via regulations or should leave it to the market.
Yeah, so, but to a large extent, you were very much in the same position as regulators in the US or UK or Japan or whatever, who are keeping their eye on. And I agree entirely. It sounds lovely until you dig into it and then say, well, what is it exactly? And it's a laudable goal, don't get me wrong, but it's not as simple as some people would say it is. We've got time for probably 2 or 3 more questions. Let me try and pick some that are most interesting. This is I think Essam Ayub asks a question here, which I think is, it's a little naughty that I ask you, but I want to ask you anyway. It's about compliance and regulatory burden. You know, there's always a necessary tension between the regulator and those that the regulator regulates. And you know, if the people who are regulated are happy with the regulator's not doing their job. You've been both, you know, you've been a regulated entity and you now are a regulator. But what are you doing to make the compliance burden easier, but at the same time not making the market any more risky?
I think that's a great question, Richard. And it's frankly a very delicate balancing act because we serve these various stakeholders, whether they're issuers or investors or intermediaries who have very different interests and very different views of the world. And it is only in the delicate balancing act of all of these interests that you create an efficient capital market that is amenable and acceptable to all of these parties. And actually a very good example of this is your previous question with respect to ESG, because the easiest thing for a regulator to do is decide that something is desirable, therefore something should be regulated, because regulations are, because of the compliance burden, oftentimes the most blunt instrument. And one would need to be assured that A, a problem exists, and B, that regulation is the most efficient way to address the problem and not through other mechanisms, whether they're awareness, whether they're incentives, whether they're data, maybe before you look at the issue. And one must not underestimate the importance of private remedies, because the regulators often look at public remedies. And part of this balancing act is making sure that private remedies available to market participants are as efficient as possible, are as streamlined as possible. That's why we moved the court system for the capital markets almost completely online, which helped us greatly. And that's also why we were the first entity that developed a class action lawsuit program. It's essentially to balance between the need for public remedies and public interventions versus efficient private remedies.
That's an excellent answer. Thank you very much. We have a question from John Cephos. I imagine is that John Cephos. It's quite a technical question. I'll ask it, but if you don't want to answer it, please don't feel you need to. It says, do you agree with the characterization of publicly traded companies regulated by the CMA in which PIF holds a majority stake as state-owned enterprises for money laundering or PEP purposes? It's quite technical. So, I mean, go on.
I'm aware that the individual who asked is a lawyer, which also indicates from the context of the question. And as my lawyer friends oftentimes tell me, never to answer a question that starts with, do you agree? Because that is what they describe as a leading question.
Good answer. I imagine John will be smiling at that answer. So I'm going to try and do a sort of just a bit of quick fire because I want to get through these questions. Muhammad Ali asks, local credit rating agency. There is one, isn't there? Isn't there a local credit rating agency already?
Actually, several. Part of the CMA's responsibility for regulating and licensing the capital market is that we license credit rating agencies. And currently, all of the global credit rating agencies are licensed and operate in Saudi. And actually, we are looking forward to seeing them transact more business as the debt capital market emerges in Saudi. But we're also seeing local credit rating agencies emerge. And we believe that part of this healthy competition and this open licensing regime helps both firms wanting to enter the sector and the issuers that would like to benefit from these credit rating agencies. So indeed, all of them are operating in Saudi.
Excellent, thank you. Passporting, there have been two questions on that. It's always been a bit of a dream, maybe a bit of a dream of the asset managers who want to, be registered in one jurisdiction and be able to cover the rest of them. Do you see passporting, maybe not across the entire region, but say between Saudi and the UAE, for example? Is that something that might happen?
This is something we are actually looking at, and we are looking at it not ourselves as the CMA, but as part of the broader GCC enterprise. And one of the most important things that we're looking at across the GCC platform is this idea of passporting, and what can we do, and how much can we do, and how fast can we do it, because we believe that it does provide some efficiency. And as long as we can provide a degree of harmonization and mutual comfort between the different jurisdictions, then I think this can be a desirable thing.
Yeah, it'd be good. I mean, it would be interesting to get. I think it's more interesting actually for regional asset managers than it is for globals, because it's difficult to get scale if you're just in Kuwait or just in, well, certainly if you're just in Bahrain, but you know what I mean. You want to build a bigger fund management business, and it requires more of that. So I'm going to do two more questions. First one, securities lending. Where are we with that? Is that something that you might think might see the light of day next year?
Actually, I would say that the securities lending, in terms of regulatory and operational infrastructure, is already in place. So part of the transition and the developments that have been ongoing in the capital market over the last few years included development of a framework and an infrastructure for securities lending. We are also aware, however, that it has not been as active as market participants would like it to be. So one of the initiatives that we're now looking at is to revisit the framework for securities lending. And part of revisiting the framework is soliciting market feedback from market participants on what they understand to be the barriers and how to best address them. And I think the CMA is quite amenable to revisiting the market infrastructure for security lending to make it more efficient for market participants, as long as it eventually helps with market efficiency and doesn't create undue risks, which is another balancing act we always strive for.
So final question, we need to be very quick. I think it's because of the zeitgeist. Mohammed El-Kuwaiz asks, will you consider special rules or condition for listing of tech companies, for example, governance framework or stock structure? Big story of the year, technology acceleration. We talked about fintech. We talked about VC. Clearly, the tech industry, such as it isn't really an industry, but whatever, is important. It's important to the future of Saudi Arabia. Would it go through, say, the NOMU market, or is there some other mechanisms that you're considering to encourage listings of tech companies?
Well, I would say, Richard, part of the developments that we've been working on over the past few years, whether have been geared specifically towards attracting new classes of sectors, whether it's technology or otherwise, to benefit from the market, for the benefit of the companies and for the benefit of the investors involved. And so this includes things like the NMU market, which has lower listing requirements, whether it's in terms of disclosures and in terms of process to list, or the creation of a new direct listing channel, which doesn't require you to do an IPO before you list. These changes were made with innovative, fast-growing companies in mind. However, we are equally cautious about wanting to gear specific changes to specific industries, because we believe that part of the efficiency of a market is that it is sector agnostic, it is company agnostic, because a particular company or a particular sector might be successful today, it might not be tomorrow. And the idea of a market is to just help businesses come in and those who are not as successful either resolve or get out, irrespective of their sector or industry.
Your Excellency, thank you so much. You've been incredibly generous with your time today. I said 45 minutes, we've gone on nearly the full hour, and I know how busy you are. So from Euromoney and from me, thank you very much for joining us and taking live and completely unscripted questions. As always, you field them as if you knew they were going to be there. It's a huge pleasure to see you as well.
Thank you very much, Richard. Thank you, everyone.
And that brings to the end our show today. I need to say a few thank yous. Obviously, I need to thank our sponsors, NCB Capital, HSBC and Samba, and of course our partners who have been with us for the whole of this series, the Ministry of Finance of the Kingdom of Saudi Arabia. I'd like to thank all of the Euromoney team who have worked on this week's event, and to give you a little bit of a promo for next week, when I will have the great pleasure of interviewing Jihad Azur, who, as you can see from your screen, is Director of the Middle East and Central Asia Department at the IMF. We're going to be discussing, in particular, the new economic outlook for the region. We'll be talking about Saudi, we'll be talking about Lebanon, we'll be talking about Egypt, and many other things, I'm sure. It's going to be a fascinating discussion. And that is at 2 o'clock, 1400 GMT, next Wednesday, the 11th of November, 2020. You will all of those that are watching will receive a further invitation to that, but you can also go to euromoneyconferences.com/Saudi or euromoney.com/live streams. And that is all I have time for today. It's been a great pleasure to have His Excellency and so many others of you joining us. And I look forward to seeing just as many of you next week for what will be, I hope, just as interesting conversation. Thank you and good afternoon.